Hey, welcome everybody on Facebook Live. This is John Dobis from Forbes talking to you from the Money Show in San Francisco. Seated next to Bob Lang from explosiveoptions.net.
That's it.
From Simi Valley. So, market, you know, options live and die by volatility, right?
Yes.
Volatility goes up, the price of options will rise, all things equal. And we've been in a kind of a low volatility environment. And so that means returns from holding options are not as good, right? In theory.
Well, yes, but we're in what's called a stock picker's market, right? And we're generally in a stock picker's market, you're not going to get hit hard by market news in general. Although the last couple of Thursdays, we've noticed, I've told you, Massacre Thursday, on the 10th and the 17th of August, we did hit a lot of volatility, and markets did roll over on this.
What was that? South Korea and the Charlottesville,
it was, you know, Donald Trump for fire and fury. It was his talking about some uncertainty or something. And the markets, you know, have been able to shake that sort of stuff off most of the year in 2017. But more recently, they're coming a little bit more concerned. And, you know, when the market comes unglued, and we saw volatility rise 44%, 37% on those 2 days alone, two of the top 10 highest percentage moves in volatility in one day. It was amazing. And what ends up happening is, you know, as you said, option premiums start to rise, right? And then, you know, those things tend to happen in very, very short spurts. But when we get volatility trends starting to go up, that's when we get a little bit more concerned.
So let's say you're somebody who's just a stock market investor looking for a little extra action, because options, after all, do provide action, if nothing else.
Absolutely.
You know, where do you start? How do you identify? You look for a stock that you think will be either going up or down in the near future, and then buy a put or a call accordingly, or spreads, or what do you do?
What I try to tell people is try to identify stocks that they are familiar with their trends, familiar with their moves. There's a lot of people who take a look at Google, they take a look at Facebook, names like that, and they're familiar with how the stocks move, their trends, right? And when they're trending up, and look, these stocks are held by large individual investors, hedge funds, pension funds, that sort of stuff. So they tend to move with the market, right? So if you get in tune, get in rhythm with those sort of stocks, you can make some good money doing options. Because I mean, look, Google is what, a $920 stock? If you want 100 shares of that, what's it going to cost you? It's going to cost
90
you
grand,
$92,000, right? But if you buy or sell one contract, you can do it for a much limited amount of risk.
So the knock against, you know, going long options is that they do have an expiration date, and after that, poof, they're gone. So, but if you manage the trade prior to that, you don't suffer total losses. How do you know when to get out of a trade that might still pan out in the future, but you want to manage your risk properly? How do you approach that?
Well, I combine my options trading with technical analysis. I use charts and technicals to help me get into a trade. I also use it to help me get out of the trade, you know. And sometimes where a lot of people suffer, where a lot of people have losses, is they get stubborn and they start looking at something and they fall in love with a particular trade. And they're stubborn to the fact that they say, you know, I'm going to stay with it even if I'm down 20, 30%. You know what? I don't care. And then all of a sudden they get down 70%. They still really don't care. And then they get down 90%, and then they say uncle, and they're out. But if they don't defer, if they're not very defensive, and if they're not disciplined enough to look at the charts and use a risk management system, that is really important. You know, look, my partner Sue Smith and I, we talk about risk management all the time. You know, if you're in a trade and you're down 50%, you know what? You might as well just cut bait, move on to the next one.
Is that a good stop number? Is there, you know, if you pay 80 cents per option and it goes down to 40, is it time to kick it out? Or
well, I mean, I would tell people, yeah, definitely yes. But what I would tell people is, you know, why don't you get into the 80-cent option? Why didn't you get into an option that's a little bit less riskier? Why don't you pay $3 for an option? You may buy fewer options, but your risk level is much better.
Gotcha.
Yeah.